This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Interested in raising funding for your startup? For your next fundraise, consider 10 Capital Syndicate Platform, an online portal using a special purpose vehicle. The Syndicate Platform allows for online investment and access to over 12,000 accredited investors. Log into the 10 Capital Syndicate Platform to find your next investment. To learn more, go to 10capital.group/SPV. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Pano Anthos, founding and managing director of XRC Labs. XRC Labs is a startup accelerator and venture fund dedicated to fostering the next generation of disruptors in the retail technology and consumer goods sectors. Pano, thanks for joining us.
Oh, nice to be here. Thank you.
Great. So what was your background before investing in early stage companies?
I was a multi-time founder. I started my career, I'm a little bit older than most folks. I started my career in the 80s, late 80s in supply chain and trademarked the term global logistics systems. So I actually own that trademark. Masayoshi-san was actually one of my investors in around 99. We raised a lot of capital in the supply chain space, and we were building the then global trade solutions that would automate e-commerce, landed cost analysis, and all the drop ships and issues that we'd have with e-commerce back in 99, 2000. And then I shifted to deep technology, object-oriented technology around integration. Then I saw that and moved to gaming. I was Unity's first customer, enterprise customer. Unity Software is a public company today. I didn't get stock. That was my big mistake because that would be worth a lot of money right now. But you learn, and I'm an early adopter, early investor. So that gaming company completely failed in 2010. And then I consulted for a while, realized I really didn't like consulting, but I also didn't want to work at a venture fund. It was too boring, too slow. And so I had been helping out some accelerators in Boston and realized that there was a wide open gap in the retail and consumer goods fields and felt that we were headed for a cliff. In 2012, you could see that consumers were highly mobile, retailers were not. Consumers were really e-commerce oriented, retailers were not. We were overstored. And at the end of the day, when you look at it, you just knew we were going to hit the cliff. Now, COVID really accelerated that. But when we started the fund in 2015, our predilection was if we were really early investors, like first money in, we could watch the wave of innovation take place. And so we became known for being really early investors and a kind of the canary in the mine. People could see with our startups what the future would look like, which has actually been the case.
That's great. So what excites you right now?
What excites me right now is the reinvention of retail. The e-commerce is the most practical explanation of the change in retail, but there's a lot of other changes going on in retail. If we start with new channels, so we were the first investors in live streaming in the US with shops. We believe that's going to only continue to grow dramatically. We love the use of drones for supply chain. So we're a big investor in Gather AI, which is a supply chain. So the idea that drones can actually do a lot of work. We like low investment thresholds. We like to see where we can put a little bit of money and have a big impact. Robotics, for example, is high money, high impact. That's a tough one for us, because we don't have a lot of money to give as an accelerator. So we look for those situations where we can have high impact and put a little bit of money to work, that the startup is very, very capital efficient. It doesn't require a lot of capital to grow the business. So new channels of retail we love a lot. We love the consumerization of healthcare. We think that the doctor's office is outmoded as a lot of retail stores. We don't need them. Why not just go remote? And we're seeing more and more of that happen. We believe food is going to go through a major transformation, much like the transformation that retail went through. And, the Warby Parkers and the direct-to-consumer model for apparel is now coming to food. And you're going to see more and more food companies selling direct with an omni-channel perspective as well, but delivering a lot more value in direct mode. So supply chain, future of food, consumerization of healthcare, new retail channels, these are all some of the things that we're focused on.
Great. So you see a lot of startups and you see a lot of investors. What's your advice for people investing in startups? What do you tell them to do before they write that first check?
Know thy founder. The founders are, at this point in the early stage of a company's life, everything. The ideas are dime a dozen. I can't tell you the number of companies where I hear the same idea. We look to the founder and we ask the question, will this man or woman or both, drive change and bust through the walls that would otherwise stop most entrepreneurs? Because it is not a pretty picture. Starting a company is bloody. It is really hard. So the founder is everything. The idea is second. We look at macro trends. We know, are they coming into a tailwind or a headwind? And so we believe re-commerce and we were very early investors in re-commerce back in 2016, but now re-commerce is really coming to the fore. The idea that rental or resale, right, of product is as important as the original sale. And that requires founders to be really a lot smarter than they used to be and think differently. So, sometimes we're too early and we'll invest 2 or 3 times. We'll say, all right, we tried that once, it's too early, we'll do it again. Because we're writing relatively small checks.
Oh, great. And then on the other side of that table, what's your advice for startups? What do you tell them to do before they go out to raise that first round?
So I actually was just on a phone with one of our startups today, and I would recommend one, having a co-founder. This is a very tough business. One of the top accelerators did their list of the top 100 of their 100 startups, and 92% of them had a co-founder. And I can't tell you how difficult it is to run a company by yourself at this early stage. Later on, when you've got 10, 20 million in revenue, no problem. You don't need a co-founder. You're the CEO. You've got people working for you. It's great. But in these early days, there are only 2 things that matter in a startup: building the product and selling the product. That's it. Nothing else matters. Legal, HR, no offense to all those great people in the world, but they just don't matter to those early stages. So if you're a founder, pick one lane and hire for the other and make that person the co-founder. You can't do both. Very rarely can the same person that sells build the product. It's highly unusual. And it's actually not optimal. It's not efficient.
Well, that's good advice. Let's talk about the state of startup investing. How do you see the industry evolving here post-COVID?
Oh, it's nuts. I don't like what I see. I feel bad for the startups. They're getting crazy valuations, which means what's going to happen is when the market corrects, it's going to be bloody. And if they don't know the term anti-dilution protection, they need to learn it. Because what investors do in these documents is they protect themselves. And the anti-dilution protection really means that when there's a down round, the people that get squeezed are the entrepreneurs, not the investors. The investors maintain their equity threshold and their value, and basically the entrepreneur gets stiff. So it's not, my biggest recommendation is don't chase valuations. Don't go after them. It's going to be a losing proposition at some point. And Bill Gurley is a great entrepreneur, investor at Benchmark. He said basically, this is a game of musical chairs. You do not want to be, the last investor standing. You want to have sold or gotten out of the business, or for the entrepreneur, you don't want to be the last one standing, and you will get hammered. So just don't chase the valuations.
I got you. That makes sense. And so what do you think is the biggest change we'll see in, say, the next 12 months?
Well, I think there's going to be a correction in the market. It is inevitable. Public markets cannot continue at this pace forever. There's going to be a correction, and when it happens, it will ripple all the way through private valuations, because a lot of the private valuations right now are pegged to public. And so literally there's going to be this chain reaction, and there's going to be a revaluation of the growth stage funds, right? The Stripes or all these players that are like Tiger putting in crazy amounts of money at ridiculous valuations. They're going to get reset, and they're going to reset all the way down the chain. So, if a founder really wants to chase that valuation, God bless them, go for it. But we're not going to play that game. It's just, we've had one company approach us, great company, we loved it. They want to do an uncapped save. I mean, it's a rationale for me to basically give them all my time and my money and get nothing in return. It's bizarre. So we're not going to do that.
So tell us more about your investment thesis, and in particular, your criteria for looking for startups. What exactly is it?
So the vast majority of the weighting is around founders, as we talked about earlier. It's probably 50%. The second biggest is not the idea itself, but the macro trend that they're marketing against. So when we found a company that's in re-commerce, we asked the question, is re-commerce really going to be an emerging trend or is it a dying trend? I mean, you'd be amazed at how many founders go after trends that are dying, that are not growing. And we think that's a really bad idea. Market size doesn't really matter to us much at this point. I mean, it's got to be big, right? You want to know that it could be big, but you're really after the trends and what's going to be 5 years from now. So for example, we know that somehow autonomous driving, some sort of autonomy is going to come down the pike. So we've invested in a number of computer vision companies, but where we see autonomy first is in drones. And then maybe later on, maybe in cars, although we're very negative about the car market because the cost of a car that goes off kilter is much higher than a drone going off kilter, right? So we look at that kind of milieu and we say, all right, let's think about the future and where it's headed. Supply chains, constant iteration, constant improvements. We're big believers in on-demand manufacturing. We believe that we're going to see much more manufacturing come back to the US with highly automated on-demand capabilities. And we're big fans of that. We've invested in that pretty deeply. We believe that, as I said, the retail channels are going to continue to change. Small stores, showrooms, no big stores, unless you're Costco but the vast majority of brands will have to have stores and they'll be tiny. So we're excited about the future. I don't know if that's answering your question, but we look at these macro trends, we kind of plot them out, we see what's going on, and then we look at the micro trends, which is, okay, what's going to get in the way of this? What's the competitive landscape look like? That's a secondary issue for us. It's important, but we want to understand if this person has a chance to win. And lastly is valuation. It's the final thing. It's not the most important, but it really can stop a deal in its tracks.
Great. Can you talk about one or two startups that fit your thesis?
Yeah, bunch actually. So I was mentioning on-demand manufacturing. Nimbly, which was in our cohort 4, has built robotic knitting capability software. Basically, they're building the AWS for knitting. Now, knitting is a $12 billion industry. Your shirt is not knit, but sweaters, anything that's knit is done on knitting machines today. And those knitting machines are done all over the world and there's mass produced, but you can do a lot of this now on demand and cut your inventory demands dramatically. So we love that company a lot. Fillogic was the one I mentioned in terms of supply chain. They've built these logistics hubs inside malls and are completely changing what same-day delivery looks like. They can basically deliver same-day delivery at 2-day prices because of the way they're re-engineering the supply chain. We love the consumerization of healthcare. So OrthoFX, which is a next-generation aligner platform, kind of a Smile Direct on steroids, is really interesting. Sanguina, which is a way for you to analyze your anemic levels with your iPhone. And the power of that, the amazing power of that, is that cancer patients need to understand their blood levels before they go in for chemotherapy. When they go wandering into an office, they figure out that they can't do it and they have to go home. And so it's a terrible experience to not have their treatment. So that's a great area. We're in a lot of this kind of diagnostics and consumerization of healthcare. Shop's very excited about live streaming. We stay very committed to that. And then in the coffee business, Terra Cafe is killing it right now in this bean-to-cup espresso capability that does lattes, cappuccinos at half the price of Italian machines. I could go on for a while. We have 100 companies, Hal, and I don't think you want to hear from all of those.
Well, that's a good example or a good sampling, I should say, and so appreciate that. So you see a lot of startups and a lot of investors out there. What do you see as the main challenge startup space today?
I love this quote. I wish I could say I came up with it. I didn't. First-time founders stress over product. Second-time founders stress over distribution. Distribution is far more the issue today than ever before. It's not just Facebook ads costing more and such. It's the overall market is changing pretty dramatically. And so you're flooded now with products from so many different consumer landscapes. And we have looked at easily 400 skincare companies that have launched in the last year and a half. 400, Hall. What do you do with 400 skincare companies, right? They're not all going to survive. So distribution is everything in today's market, much more so product. I mean, really one skincare versus another. I'm not just saying skincare founders. Don't get me wrong. I know you're special and what you're building is unique, et cetera, et cetera. But let's be candid here. I mean, we just don't need 400 skincare companies. And so distribution is really everything. And same thing in enterprise software. I mean, you build your product, you got to have customers using it and customer adoption. So we're telling founders, focus on distribution, focus on the customer, make sure your customers are really happy with the product. Then worry, obsess over the quality of the product afterward. So, I hate to use an MVP, minimum viable product. That's really not my point. My point is make sure you've got customers who love what you're doing, even if it's a small circle.
And then what do you see as the main challenge investors face today?
Deciding. I mean, there's just so much volume. It's ridiculous. We are getting, I can't tell you how many inbounds a day right now. And we're kind of like, our selection process is over. So as an investor, your ability to sift through all this deal volume, we have a sourcing team that's quite large now, strictly because of the volume that's come in. We can't simply rely on partners to just source their own deals or manage it themselves. And, you run the risk of missing the winners. I mean, I'll give you a great example. Billy, which is a great company doing extremely well, came in. They had no product. Their founders had no previous experience in the industry. And it's a guy CEO running a women's razor brand, and shaving company. Like, okay, so like that doesn't jive easily. And yet it's been a blowout hit. So the ability to spend time and research these companies in a little more depth requires a personnel staffing level that is nothing like we've ever seen.
Great. Well, you mentioned a lot of sectors and applications today, but if you had to pick one or two that you put at the top of the list for being really good immediate opportunities for investors, what do you put up there?
Oh, I put up the consumerization of healthcare. We're talking about a multi-trillion-dollar industry that's being shaken at its very roots. It's not, the doctors won't go away, but doctors' offices will go away. The ability for remote care to take place, self-care is growing exponentially. And we have a company actually that basically is building the building blocks for which doctors get connected to patients through brands asynchronously in a really interesting way. So we just think that the future is really about flattening the cost of healthcare by efficiency and technology as opposed to government policy. It's a big one. Supply chain will always be big, and it's only going to get bigger. My first company was in supply chain, but I can tell you that it is crazy right now how important supply chains are. When I started, it was called physical distribution. We didn't use the term supply chain. Now it's all about supply chain. So I find it ironic and interesting at the same time. So I love the fact that it's strategic now. Thank goodness.
It's great. It's back in vogue. That's good to hear. Well, in the last few minutes that we have here, what else should we cover that we haven't?
So my encouragement to founders is have 2 ears and 1 mouth. And by that, I mean, listen carefully, speak, don't be shy. You need to have conviction, but you have to have a big dose of humility and humbleness with confidence. And you usually see one and not the other. You see either people who are too humble and are afraid to execute and just can't get out of their own way, or you see them so cocky and confident that they make time and mistakes. The other thing that I would recommend is, and we're very excited about this, is we have been emphasizing what we call the underrepresented founders, underacknowledged founders. They're minority founders that really do need and can excel if they get the chance. And so we're, both for investors and for ourselves and for our entrepreneurs, we're elevating them. We want them to have a much more opportunity. It doesn't cost us anything. And actually, we're seeing results from it already. So we're excited by the ability for underrepresented founders to get time and attention. And they are listening very carefully, Hall. They are listening. They are really working hard and they're executing extremely well. So we're excited by that program and believe that every venture fund should be effectively doing the same thing.
Well, great. Well, how best for listeners to get back in touch with you?
So my email address is Pano, P-A-N-O, that's piano without the I, at xrclabs.com. I welcome any type of founder. As we said, you can have an idea, you don't have an idea. We love underrepresented founders. We want to give you airtime and be supportive. And we're always in business 24/7. So please, by all means, reach out to us. We'd love to chat.
Great. We'll include that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thanks, Hall.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.